The Monday deadline, Basel 3rd. Enforcement. If you're watching this on Sunday night, you still have time. But if you're seeing this after the market opens Monday, it may already be too late. Because what looks like a normal move in gold and silver is actually a legal trigger, a rule flip, a deadline the banks can't ignore anymore. And when the clock hits market open, paper claims become a liability, and physical metal becomes the escape door. Here's the part nobody is saying out loud. What happens if even one major bank can't comply? Because if that happens, the entire pricing system could crack, and the real price may show up overnight. Stay with me, because in the next few minutes, I'm going to show you what they're rushing to do, and why the next 72 hours could rewrite everything. Welcome to Market Metal. If you're someone who's been around long enough to know, when they say it's fine, it's usually not. Then please, subscribe right now, not for hype, but so you don't miss the updates when this moves fast. And tell me in the comments, where are you watching from today? The regulatory shift that markets ignored. On a quiet weekend, most traders looked at the price screens and saw what seemed like a routine move. Gold was slightly higher. Silver showed a modest rise. The financial headlines pointed to the usual reasons: currency shifts, interest rate rumors, or geopolitical tension. For many observers, it appeared to be another normal fluctuation inside a familiar cycle. Yet beneath that calm surface, a structural change was moving through the banking system, one that had been discussed for years but rarely treated as urgent. This change was not a new law announced overnight. It was the strict enforcement of a rule that had been developed slowly after the global financial crisis. For more than a decade, regulators had worked on strengthening bank balance sheets so that institutions could survive future shocks. The framework that guided this effort became known as Basel III. Its purpose was simple in theory. Banks should hold more stable funding and rely less on fragile, short-term leverage. In practice, the transition was long and complex, filled with delays, negotiations, and temporary exemptions. For years, many market participants assumed that the strictest parts of these rules would continue to be postponed. They had seen earlier deadlines pushed forward. They had watched regulators allow gradual adjustments instead of sudden enforcement. Because of that history, the final phase did not feel urgent to most traders. It was treated as another distant policy detail rather than an event that could influence prices in the near term. However, the situation changed when enforcement shifted from guidance to obligation. Under the net stable funding ratio, often shortened to NSFR, banks were required to match certain assets with stable, reliable funding. The goal was to reduce the risk that institutions would rely on fragile financing during stress. When the rule was applied more strictly, some exposures that once looked efficient suddenly became expensive to maintain. One of the most important changes involved the treatment of unallocated precious metal positions. In earlier frameworks, banks could carry large exposures through derivatives, forwards, or unallocated accounts without holding large amounts of stable capital against them. These positions were considered manageable because they were assumed to be liquid and easily rolled forward. The cost of maintaining them on the balance sheet was relatively low. With stricter NSFR enforcement, the classification shifted. Certain unallocated exposures were now viewed as less stable and more sensitive to market stress. That reclassification did not accuse anyone of wrongdoing. Instead, it reflected a regulatory judgment that paper claims could behave differently from fully allocated physical holdings during periods of pressure. As a result, banks faced higher funding requirements if they chose to maintain those positions. For institutions that had built strategies around capital efficiency, this change mattered. When the cost of carrying an exposure increases, the decision is no longer only about market direction. It becomes a balance sheet question. Executives must ask whether the return from the position justifies the additional funding burden. If the answer is no, the exposure is often reduced, regardless of price expectations. This is why regulatory shifts can move markets even when economic data remains unchanged. Price movements do not always begin with demand from investors. Sometimes they begin with adjustments inside bank balance sheets. When many institutions face the same rule at the same time, their decisions can align. That alignment can create sudden changes in liquidity. History offers several examples of this pattern. In previous cycles, margin adjustments or capital rule changes forced large participants to reduce leverage quickly. The resulting price moves were later explained as volatility, but the underlying cause was structural. Regulation altered incentives, and the market responded. In the current situation, the timeline was especially important. After years of gradual transition, the shift towards stricter compliance compressed decisions into a narrow window. Banks that had relied on transitional treatment now had to evaluate their positions under the final standard. Even if they had planned for the change, the exact timing created operational pressure. Balance sheets do not adjust instantly. Collateral must be moved. Funding lines must be secured. Risk committees must approve new allocations. Because these steps take time, late recognition of the deadline can produce urgency. Institutions prefer to act before a rule becomes binding rather than after. Acting early provides flexibility. Acting late can force decisions under stress. When several large players act at once, the effect can appear on price charts as a sudden spike or drop, even though the driver is administrative rather than emotional. Another reason the shift was underestimated is that regulatory language rarely attracts attention outside specialist circles. Terms like stable funding ratio or liquidity coverage sound technical and distant from daily trading. Media coverage tends to focus on interest rates, inflation, or geopolitical news because those topics are easier to explain. Structural balance sheet rules, although powerful, remain mostly invisible to the broader audience. Yet inside financial institutions, these rules shape behavior. Treasury departments monitor funding ratios. Risk teams track how each position affects regulatory metrics. When a rule changes classification, it can alter internal limits overnight. A trade that was acceptable last quarter may require new capital today. The market may not see that decision process, but the resulting orders eventually appear in trading volume. The distinction between allocated and unallocated holdings became central in this environment. Allocated physical metal, held with clear ownership and custody, was generally treated as more stable from a regulatory perspective. Unallocated claims, which depend on counterparties and contractual promises, carry different assumptions about liquidity during stress. The difference was not philosophical. It was about how assets behave when funding tightens. For banks, this created a choice. They could increase stable funding to maintain existing exposures, or they could reduce positions that no longer fit within their balance sheet strategy. Neither option was inherently dramatic. Both were routine responses to new constraints. However, when many institutions evaluate the same constraint simultaneously, the combined effect can be visible in market prices. This is why some price movements that appear sudden are actually the result of long preparation. The rule did not appear overnight. It was discussed in committees, published in drafts, and refined through consultation. Central banks and regulators signaled their intention to strengthen funding standards for years, but markets often react only when enforcement becomes immediate. From a strategic perspective, the key lesson is that regulatory timelines matter as much as economic data. Businesses that monitor only headlines may miss shifts in capital treatment that influence large financial players. Entrepreneurs and investors who track policy implementation can sometimes anticipate where liquidity may tighten or expand. In this case, the approaching deadline acted like a switch. Before enforcement, institutions could operate under transitional assumptions. After enforcement, those assumptions no longer applied. Even if the underlying supply and demand for metals did not change overnight, the cost of carrying certain exposures did. That alone was enough to prompt repositioning. The broader implication extended beyond one market. Basel III was designed to reduce systemic fragility by encouraging banks to rely on assets and funding sources that remain stable during stress. When such a framework reaches its final stage, it reveals where leverage had quietly accumulated. Areas that depended heavily on favorable capital treatment become visible. For decision makers in the business community, this moment served as a reminder that financial systems evolve through policy as well as through markets. Regulations are not merely background rules. They shape incentives, costs, and behavior. When a long-delayed standard becomes active, it can trigger adjustments that appear sudden but were building for years. As the new week approached, the visible market signals were modest. Prices moved within familiar ranges. Headlines remained calm. Yet inside risk departments and treasury desks, calculations were being updated. Funding ratios were reviewed. Exposure reports were compared against the new requirements. These quiet processes rarely attract public attention, but they often precede visible shifts in liquidity. The regulatory shift, therefore, was less about a single price move and more about a change in incentives across the banking sector. It marked the transition from a period of flexibility to one of stricter discipline. Markets sometimes ignore such transitions until the moment they become binding. By then, the adjustment is already underway. In the end, the event was not defined by drama, but by structure. A rule designed after a past crisis reached its final stage. Balance sheets had to reflect the new reality. Institutions responded according to their constraints. And while many observers focused on short-term price explanations, the deeper driver was a regulatory framework quietly reshaping how risk could be carried. Balance sheet mechanics and the pressure on paper. Markets. By late Sunday evening, the public market remained quiet, but inside large financial institutions, the atmosphere was very different. Risk managers were not watching headlines. They were watching balance sheet ratios. Treasury teams were reviewing funding tables line by line. Senior executives were asking a simple but urgent question. Which positions would become expensive the moment the new funding rules were fully enforced? The issue was not about whether gold or silver would rise or fall that week. The issue was about capital efficiency. For years, many commodity exposures had been maintained because they required relatively little stable funding. Banks could support large derivative books while keeping their core capital allocated elsewhere. That structure worked as long as regulatory treatment remained favorable. Once the treatment changed, the same positions began to consume scarce resources. Under stricter funding requirements, exposures that relied on short-term or flexible financing suddenly demanded more stable backing. Stable funding is not free. It ties up cash, high-quality collateral, or long-term financing that could otherwise support lending or market making in other sectors. When the cost of holding a position rises sharply, the question shifts from, is this trade profitable, to, is this trade worth the balance sheet space? This is the moment when leverage becomes visible. Commodity finance, especially in metals, has long relied on layered structures, futures, forwards, swaps, and unallocated accounts that provide liquidity to producers, refiners, manufacturers, and investors. These instruments are not inherently risky. They are tools that allow hedging and price discovery. However, they also depend on the assumption that positions can be rolled forward smoothly and financed at reasonable cost. When regulation increases the required stability of funding, that assumption weakens. Inside the banks, analysts began running updated capital models. Each exposure was recalculated under the stricter standard. Positions that once fit comfortably within internal limits now pushed against them. The math was straightforward. If maintaining a certain book required significantly more stable funding, the return on that book fell, even if market prices had not moved at all. At this stage, institutions typically have three pathways. They can allocate additional stable funding to preserve the exposure. They can restructure the exposure to reduce its regulatory footprint, or they can reduce the position entirely. None of these choices is dramatic in isolation. But when many institutions face the same constraint at the same time, their actions begin to align. Alignment is what creates pressure in markets. If several large participants attempt to reduce similar exposures during the same window, liquidity can thin quickly. Orders that would normally be absorbed by the market now move prices more than expected. Observers may describe the move as sudden volatility, yet the underlying cause is coordinated balance sheet adjustment rather than new information about supply or demand. This dynamic has appeared before. In previous cycles, margin changes in commodity or equity derivatives forced rapid deleveraging. Prices moved sharply, not because fundamentals changed overnight, but because capital rules changed the cost of holding risk. Once leverage is unwound, markets often stabilize, but the transition period can be intense. In the current environment, algorithmic trading systems add another layer. Many institutional strategies are designed to respond automatically to shifts in liquidity and volatility. When large balance sheet adjustments begin, these systems detect the change in order flow. They may widen spreads, reduce quoted size, or adjust hedges in real time. None of these actions is malicious. They are programmed responses to protect capital. Yet together, they can amplify price movement. This is how a liquidity cascade forms. It rarely starts with panic. It starts with routine compliance. A desk reduces exposure to improve its funding ratio. Another desk observes thinner liquidity and adjusts its own limits. Algorithms detect rising volatility and pull back from providing depth. The combined effect is a market that moves faster than usual, even though each participant is acting rationally within their constraints. From the outside, such a sequence can look mysterious. Commentators may attribute the move to sentiment or rumors. In reality, the driver is structural. When the cost of leverage rises, leveraged positions shrink. When those positions are large, their reduction becomes visible in price behavior. Another pressure point lies in collateral management. Higher funding requirements often mean more high-quality assets must be pledged or held unencumbered. Banks must decide where to allocate those scarce resources. If capital is tied up supporting one book, it cannot support another. This creates internal competition for balance sheet space. Senior management, therefore, prioritizes activities that provide stable revenue with lower regulatory cost. Activities that consume large amounts of funding for modest return become candidates for reduction. Over time, this reprioritization reshapes market participation. Liquidity providers may step back from certain segments, leaving fewer intermediaries to absorb large flows. When fewer intermediaries remain, price discovery becomes more sensitive. For entrepreneurs and business leaders who depend on commodity inputs, this sensitivity matters. Short-term price swings can affect hedging costs, procurement planning, and contract negotiations. Even if long-term fundamentals remain unchanged, the transition period can introduce uncertainty into operating budgets. During such periods, the difference between paper exposure and physical supply chains also becomes more visible. Derivative markets can adjust rapidly because contracts can be closed or rolled within minutes. Physical logistics, mining, refining, shipping move at a much slower pace. When financial positioning shifts faster than physical supply, temporary gaps between quoted prices and real-world transactions can appear. These gaps are not permanent distortions. They are signals that the financial layer is adjusting more quickly than the industrial layer. Over time, arbitrage and new participation usually restore balance. However, the initial phase can feel abrupt to those who are not monitoring the structural drivers. Inside the institutions, the weekend became a planning window. Compliance teams confirmed how the new ratios would be calculated at the next reporting point. Treasury departments evaluated which funding sources were stable enough under the revised definitions. Trading desks reviewed exposure reports and prepared contingency plans for different liquidity scenarios. No single meeting decided the market's direction. Instead, hundreds of small decisions accumulated. Each desk aimed to reduce regulatory pressure while maintaining client service. Each adjustment was logical on its own. Together, they formed a broader repositioning. This is the quiet mechanism through which regulation influences price. It does not announce itself with a headline. It appears as subtle changes in order size, bid-ask spreads, and inventory levels. Analysts who watch only price may see noise. Analysts who watch balance sheet behavior see structure. As the new week approached, the key uncertainty was not whether institutions would act, but how quickly. If adjustments were spread over time, markets could absorb them smoothly. If many participants moved simultaneously, volatility would likely increase. The outcome depended less on sentiment and more on operational timing, when desks executed their planned reductions or reallocations. For serious decision makers, the lesson was practical. Market moves are often the visible result of invisible constraints. When funding rules tighten, leverage contracts. When leverage contracts across multiple institutions, liquidity thins. And when liquidity thins, prices respond more sharply to each transaction. In this phase, there was no need for dramatic narratives. The mechanics were sufficient. Capital had become more expensive for certain exposures. Institutions were responding as they always do, by protecting their balance sheets. The market, in turn, was beginning to reflect that shift, not through headlines, but through the quiet, measurable signs of changing liquidity. Systemic implications. Beyond precious metals. By the time the new week approached, the discussion inside financial institutions had already moved beyond a single market. What began as a technical adjustment in funding treatment was now being evaluated through a wider lens. Senior risk committees were no longer asking only how the rule would affect specific commodity exposures. They were asking a broader question. What does this change reveal about leverage across the system? Basel reforms were never designed to target one asset class. Their purpose, since the aftermath of the global financial crisis, was to reduce hidden fragility. Regulators had observed that many institutions entered periods of stress with balance sheets that looked strong on paper, but relied heavily on short-term funding. As when liquidity tightened, those structures failed quickly. The response was a framework that encouraged banks to hold assets that could remain stable during pressure and to fund positions with more durable sources. When a framework like this reaches its final stage of enforcement, it acts like a spotlight. It does not create leverage. It exposes where leverage already exists. Areas that functioned smoothly under flexible rules suddenly show their dependence on favorable treatment. This is why the current shift was being studied not only by commodity desks, but also by teams responsible for credit, rates, and cross-asset risk. Large financial markets are connected through counterparty relationships. A bank that provides liquidity in metals may also be a major participant in currency swaps, interest rate derivatives, and corporate financing. If its balance sheet becomes constrained in one area, the effect can ripple outward. Reduced capacity in a single segment can influence funding costs elsewhere, even if the underlying assets are unrelated. This interconnected structure is often invisible during stable periods. Transactions clear normally. Funding is available. Spreads remain tight. However, when constraints appear, the links become clear. If one participant reduces activity, others must decide whether to fill the gap or conserve their own capital. The decision is rarely emotional. It is based on risk tolerance and regulatory limits. Yet when several institutions choose caution at the same time, liquidity across multiple markets can shift. The timing of this regulatory enforcement also intersected with a broader macro environment that was already sensitive. Global debt levels were high by historical standards. Central banks had spent years balancing inflation control with financial stability. In such an environment, any policy that encouraged stronger balance sheets was intended as a safeguard. At the same time, safeguards can reveal where previous growth depended on leverage. For analysts, the key question was not whether the rule would cause instability, but whether it would accelerate adjustments that were already underway. Financial systems often move in phases. First, leverage expands during periods of easy funding. Then, as conditions tighten, institutions gradually reduce risk. When regulation becomes stricter, that reduction can become more visible and more coordinated. Another dimension involved counterparty confidence. Markets function smoothly when participants trust that obligations will be met. Strong funding ratios are meant to reinforce that trust. However, the transition period, when institutions are still adjusting, can produce temporary uncertainty. Participants may widen credit limits or shorten maturities until they see how peers respond. These small defensive steps can influence liquidity even without any actual failure. From the perspective of policymakers, this is a known trade-off. Stricter standards reduce long-term systemic risk, but can create short-term friction as the system adapts. The objective is not to eliminate market movement, but to prevent the type of cascading failures seen in earlier crises. By encouraging assets with clear ownership and stable funding, regulators aim to ensure that stress events remain contained rather than spreading through opaque leverage. Within this context, precious metals served as a case study rather than the entire story. The distinction between allocated and unallocated holdings highlighted a broader principle. Assets with direct, verifiable backing tend to behave differently during stress than those dependent on layered claims. This principle applies across finance, from secured lending to collateralized funding markets. Institutional asset allocation was already evolving along similar lines. Over recent years, many central banks had emphasized reserves that could maintain value under multiple scenarios. Sovereign wealth funds had diversified across regions and asset types to reduce concentration risk. The regulatory shift aligned with that broader trend toward resilience. For business leaders observing these developments, the implication extended beyond trading desks. Companies that rely on external financing or complex hedging programs depend indirectly on the health of intermediary balance sheets. When those balance sheets tighten, credit availability, hedging costs, and contract terms can change. Even firms with strong fundamentals may notice shifts in pricing or collateral requirements. Another signal worth monitoring was the behavior of funding markets themselves. Spreads in short-term lending, repo activity, and demand for high-quality collateral often reveal stress before it appears in equity or commodity prices. During periods of regulatory transition, these indicators can show whether institutions are competing for stable funding or comfortably meeting requirements. At the same time, technology continued to shape how quickly adjustments spread. Modern trading infrastructure allows institutions to rebalance exposures within minutes. Risk dashboards update in real time. This speed improves transparency, but also means that responses to new constraints can occur almost simultaneously across regions. What once unfolded over weeks can now happen within a single session. Despite this speed, the underlying objective remained stability. Regulators were not attempting to direct prices. Their goal was to ensure that institutions could withstand shocks without requiring emergency support. From a systemic perspective, stronger funding structures reduce the probability of sudden insolvency. The challenge lies in managing the transition without creating unnecessary disruption. Historical parallels illustrate this pattern. After previous crises, new capital and liquidity standards initially appeared restrictive. Over time, markets adapted, business models evolved, and the system operated with less hidden leverage. The adjustment period was often marked by volatility, followed by a more resilient structure. Observers who focused only on short-term price moves sometimes missed the longer-term improvement in stability. In the present case, the regulatory enforcement served as a reminder that financial architecture is continuously refined. Policies introduced after one crisis are tested by the next cycle. Each refinement aims to close gaps that once allowed risk to accumulate unnoticed. When those refinements reach full implementation, they reveal which activities were sustainable and which relied on favorable conditions. For decision makers, the practical takeaway was not to predict dramatic outcomes, but to recognize shifting incentives. When stable funding becomes more valuable, institutions allocate capital differently. Activities with transparent collateral and predictable liquidity gain preference. Activities that depend on rolling leverage face higher scrutiny. This reallocation can influence pricing across several asset classes, not because fundamentals changed, but because balance sheet priorities did. As the enforcement date arrived, the visible markets still appeared orderly. Prices moved, but within ranges that could be explained by ordinary trading. Beneath that surface, however, a structural adjustment was progressing. Funding models were being recalibrated, exposure limits were being updated, counterparty assessments were being reviewed. These processes rarely produce headlines, yet they shape the environment in which all participants operate. The suspense, therefore, did not come from a single dramatic event. It came from uncertainty about how quickly the system would complete its adjustment. Would changes unfold gradually, allowing liquidity to adapt? Or would several constraints converge at once, revealing pressure points that had been hidden during easier conditions? The answer depended less on sentiment and more on the timing of institutional decisions. In this phase, the financial system resembled a network preparing for a scheduled test. The rules were known. The objectives were clear. What remained uncertain was how each node in the network would respond under the new parameters. For those watching closely, the signals would not appear in headlines, but in the subtle shifts of funding costs, collateral demand, and participation levels across interconnected markets. Strategic positioning, and the decision framework for businesses. As the first trading sessions under the stricter framework began, the most important question for business leaders was no longer what caused the regulatory shift, but how to operate within the environment it created. Markets were not collapsing, and there was no single dramatic headline. Instead, there was a quiet change in priorities across financial institutions. Balance sheet strength had moved from being a compliance metric to becoming a competitive advantage. For companies that depend on credit lines, hedging programs, or commodity inputs, this shift required careful observation. When banks face tighter funding requirements, they do not stop operating. They adjust how they allocate capital. Activities that consume large amounts of stable funding are reviewed more strictly. Transactions that offer predictable returns with lower regulatory cost are favored. Over time, this reordering of priorities can influence which clients receive the most favorable terms. The first practical implication was liquidity planning. Businesses that had relied on a single funding source were now exposed to greater risk if that source became constrained. A resilient strategy required diversification, multiple banking relationships, staggered maturities, and clear visibility into covenant terms. None of these measures were new ideas, but regulatory transitions often reveal which organizations had treated them as theory rather than practice. The second implication involved cost stability. When financial intermediaries face higher capital requirements, some of that cost can flow through to borrowers or hedging clients. This does not happen instantly, and it is rarely announced as a policy change. Instead, it appears gradually in the form of wider spreads, higher collateral requests, or shorter contract durations. Companies that monitor these signals early can adjust procurement and pricing strategies before margins are affected. Another area of attention was supply chain resilience. Industries that depend on metals for manufacturing, electronics, energy infrastructure, transportation, often use financial hedges to manage price volatility. If liquidity in derivative markets becomes thinner, hedging can become more expensive or less flexible. In such conditions, operational teams may need to coordinate more closely with finance departments to balance physical inventory with financial protection. From a strategic viewpoint, the regulatory shift encouraged a return to fundamentals. During periods of abundant leverage, growth can be driven by inexpensive financing. When funding becomes more disciplined, competitive advantage shifts toward efficiency, cash flow quality, and balance sheet durability. Businesses with strong internal liquidity are better positioned to navigate temporary market dislocations without making rushed decisions. The decision framework for executives therefore centered on three questions. First, how exposed is the organization to sudden changes in financing conditions? Second, which contracts or partnerships depend heavily on intermediary balance sheets? Third, what buffers exist if volatility increases in input costs or credit availability? Answering these questions did not require dramatic action, but it did require honest assessment. Scenario planning became particularly valuable. One scenario assumed that markets would adjust smoothly, with only modest changes in spreads and liquidity. Another considered a period of sharper repricing as institutions completed their balance sheet adjustments. A third examined the possibility of temporary dislocations in specific segments, short-lived gaps between quoted prices and actual transaction costs. Preparing for each scenario allowed leadership teams to respond calmly rather than react under pressure. A practical checklist emerged from this approach. Maintain sufficient cash or near-cash reserves to cover operating needs during volatile periods. Review hedging strategies to ensure they remain effective if margin or collateral terms change. Reconfirm supply agreements with key vendors to understand how price adjustments would be communicated. And most importantly, keep communication channels open with financial partners to detect early signs of shifting credit conditions. There was also an opportunity dimension. Periods of regulatory transition often create inefficiencies that disciplined organizations can use to their advantage. When some participants withdraw from certain activities due to higher capital costs, others with stronger balance sheets may step in. This can open space for negotiated terms, strategic inventory accumulation, or long-term contracts secured at favorable levels. The key is patience and clear risk limits rather than aggressive speculation. For aspiring entrepreneurs and younger executives, the moment served as a lesson in how financial systems evolve. Markets are not shaped only by earnings or demand. They are also shaped by rules that define how risk can be carried. Understanding those rules provides insight into why liquidity appears abundant in one cycle and scarce in another. It also explains why organizations that prioritize resilience often outperform those that rely solely on rapid expansion. The broader narrative was not about crisis, but about transition. Regulators were attempting to reduce the probability of future systemic shocks by encouraging stronger funding structures today. Institutions were adapting their behavior to meet those expectations. The adjustment process could produce periods of volatility, yet its long-term aim was stability. For businesses, recognizing this distinction prevented overreaction while still encouraging preparedness. Another important consideration was information discipline. During uncertain periods, media narratives can shift quickly, sometimes emphasizing dramatic interpretations of routine adjustments. Decision-makers benefited from focusing on measurable indicators instead: funding spreads, collateral requirements, delivery times, and contract terms. These signals provided a clearer picture than commentary driven by short-term price movements. As the week progressed, the environment rewarded organizations that moved deliberately. Those with diversified funding, transparent inventories, and flexible procurement strategies found that they could operate without urgency. Those that had depended on narrow margins or concentrated financing faced more difficult negotiations. The difference was not luck, it was the result of prior planning. In the end, the regulatory deadline did not dictate a single market outcome. Instead, it reshaped incentives across the financial system. Banks prioritized stable assets and reliable funding. Liquidity providers adjusted their participation. Businesses reassessed their exposure to financing conditions. Each participant acted according to their constraints, and together those actions defined the new equilibrium. The underlying message for leaders was straightforward. Structural policy shifts rarely announce themselves with dramatic events, yet they influence the cost and availability of capital for years afterward. Organizations that treat such moments as signals rather than noise can strengthen their positioning before changes become obvious to competitors. As the first full cycle under the new standards unfolded, uncertainty gradually gave way to clarity. Markets began to reflect the updated balance sheet realities. Funding patterns stabilized around the stricter requirements. What initially felt like suspense resolved into a new baseline for how risk would be financed. For those who had prepared, the transition was manageable. For those who had ignored the signals, the adjustment required faster, more expensive decisions. In this way, the final stage of Basel III enforcement functioned less as a shock and more as a filter. It distinguished between strategies built on durable funding and those dependent on flexible leverage. For the business community, the lesson was enduring. In any financial cycle, resilience is not merely defensive. It is a strategic asset that determines who can continue operating confidently when the rules of the system quietly change.